All right, this is Town of Monroe Pension Committee and OPEB Board of Trustees. Regular meeting, special meeting, I'm sorry, Thursday, October 26th, 6 p.m. This meeting will be conducted in part by electronic equipment pursuant to Connecticut state law. This meeting will be recorded and made available on the town's website. If you are attending remotely, please remember to mute your microphone unless you are speaking. Anyone participating remotely should state their name and title if applicable at the outset of each occasion. At the first such person is speaking, all votes taken during with any member of this body or participating remotely shall be taken by roll call. Unless the vote is unanimous, the chat feature will not be utilized during this meeting. All right. We are called to order. I see Steve Kirsch.
Present.
Frank Duchess.
Present.
Jonathan Formicello.
Present.
I know Ken Kellogg is not. Joe Gobso.
Here.
Sorry about that. Jason Maurer.
Present.
Mike Vitella.
Mike is not here.
Not here. Okay. And then who am I missing? I got Dennis Condon on here.
Dennis called. He said he's running late.
Got it. And Chrissy Martinez.
Not here.
Not here. And I know we have Ron.
Here.
Ofsky and Heidi B.
Here.
All right. Review of minutes for the pension committee.
Yeah, this is Mike Vitale calling in.
Hey, Mike.
No, Mike
Hi,
is
how are
here.
you?
Just in time. We'll switch you to the on-time column.
Okay, thank you.
Make a motion to accept the minutes of the last meeting.
Jonathan Formicello, second.
Okay. Any discussion, questions, additions, subtractions? Hearing none. Any opposed? We pass unanimously.
And I don't know if you want to take a separate vote for OPEB, Mike. But
Yeah, yes, please.
Yeah.
I'll make a motion to approve the minutes. Jonathan Formicello, second.
Perfect. Any questions, concerns, process?
Yep.
All right. Hearing none. Any opposed? Hearing none, we pass unanimously. All right, new business. Devin, it's up to you.
Okay, wonderful. Thank you for accommodating my schedule. I had an in-person meeting in Old Lyme at 4 o'clock, so I'm down on the shore. It was not possible for me to transport myself in time. So as per usual, I'll go through the governance calendar, go through the capital markets, review both portfolios, and then we do have a voting item for the OPEB. So please let me know if I should shift the timing, but certainly I heard someone mention that they had to leave by 7. We'll certainly be wrapped up well before that. Wonderful. So let me go ahead and share my screen. And I'm just going to make sure that I make this as big as possible. All righty. So the third quarter fiduciary governance calendar focuses on the pension landscape within the municipal arena. So as we have frequently discussed, the town of Monroe stacks up very well compared to peers. So Hooker and Holcomb only does a VAL report biannually. So the most recent one was in 2022. Then they'll do one in 2024 as well. So if you compare the results from 2020 to 2022, you'll see that both the town plan and the Board of Ed plan made improvements in their funded status. So the town plan went from 94% funded, which already was quite strong, to almost 99% funded. So fantastic move. And the Board of Ed plan went from just about 91% funded to over 97% funded. So this is fantastic news, especially given the fact that 2022, fiscal year 2022 was really difficult. as we all know, the markets in calendar year 2022 struggled mightily. So asset values were much lower midway through 2022 than they were the year before. You have the benefit of having the Val report done in 2020 and 2022. If we had compared 2021 to 22, you probably would have seen a bit of a decline in funded status, but this funded status north of 95% is very, very strong, and you'll see some of the comparative peer results in the following slides. One other thing that I will point out is that your return assumption is 6.75%. That is something that the committee has been discussing over the years, and I think it's worth another discussion because when we look at some of the peer results, you'll see that the trend has been to continue to reduce. So we'll talk about that. But before we do that, just take a look at the OPEB plan. Again, great improvement in funded status. This is because you've been making contributions into the OPEB plan. So in 2020, the plan was just about 44% funded. And as of the most recent valuation, it was close to 83% funded. Again, much stronger than what we see in most peers. So here on page 9, here's where you see what the trends in return assumptions have been. And certainly the trend has been downward. So if we look at the graph on the right-hand side of the page, you can see that both the average and the median have trended downward very significantly. Used to be north of 7% back in 2015, and now are right at 6.5%. So the average return assumption is 6.46% across the state of Connecticut, and the median is 6.5%. So remember that you are at 6.75%. So if you look at this column, the 6.75 to 6.99%, 24% of your peers have a return assumption in this range. But 52% of peers are below 6.75%. So more than half of your peers have a return assumption lower than yours. Given the very strong funded status, that could be something that's on the table. It is important to talk with the actuary about reducing the return assumption, because when you lower the return assumption, that means
Funded
that
status drops, right?
Annually required contribution is higher. So you need to be mindful of the timing, but I certainly think that it's something that we could talk about with the folks from Hooker and Holcomb. And our next quarter's governance calendar review is where we do our asset allocation modeling. So we take our updated capital market assumptions, we model out your portfolio, and we can also model out a variety of other portfolios, perhaps a bit more conservative, and think about what it would take to lower that return assumption. I don't think it would create a significant shift in the portfolio. So I do think that that's something that we might want to consider, moving from 6 3/4 down to 6.5%, in line with what most peers are doing. So if we look, here's the really good news. On page 10, you can see the trend in funded ratios. And again, this is comparing 2021 to 2022. We don't have that direct comparison because you only get that Val report every other year. But the average funded ratio was at 72.4%. Previously in fiscal year 2021, it was at almost 86% funded, but the funded status did come down to 72.4. Remember, you're at almost 99% for the town plan and 97% for the Board of Ed plan. So you are well above where peers are in terms of the overall health of the plan. And if you look at some of these metrics, you can see here is the peer group. So only 12% of plans are between 90 and 100% funded, and only 7% are above 100% funded. So you are certainly well ahead of where most plans in the state of Connecticut are. All right, and then we can see the trend in funded status going back to 2017. And again, we did see a spike up in 2021 because that was a very strong asset year, then a decline in 2022 when we had difficult market environment. You know, for the most part, the average funded status hasn't changed too significantly going back to 2017. But again, if we were to plot out where the town of Monroe falls on this graph, it would be right up here near that 100% funded status. So very strong relative to where most plans in the state of Connecticut are. Then we take a look at OPEB on page 12. So only just north of half of OPEB plans are unfunded, and just under half are funded with an OPEB trust. The average funded ratio in 2022 for plans that are funded was 36.5%. And remember that you are at 82.7%. So much better funded status than the typical peer. The median investment return assumption is 6.25. And your return assumption is 6.5. So again, when it comes to the actual return assumption that's being used, the town's return assumption is a little bit higher than what we see for the broad peer group. So again, that's something that we could consider lowering when we have those conversations with folks from Hooper and Holcomb. So I'll take a pause. I'll actually stop sharing the screen for a moment just so we can all see faces. Any questions or comments about any of that information?
Yeah, Devin, just to the question about the funded, I mean, the return assumptions. Is there a formula, like if we're dropping a quarter point, like what would that drop our funded status? How much would it increase our yearly contribution? Is there a formula we use, or is it just something we have to calculate with the actuaries?
The actuary will do that calculation, but they have all of the tools to be able to do that work. I don't think it's a very heavy lift for them. So they can do kind of scenario modeling. You know, what if you were to reduce it to 6.5? What if you reduced it to 6.25? What
right.
Exactly. Yep. They can easily do that work. So if you'd like, we could perhaps invite them to the January meeting and maybe have that conversation alongside the asset allocation discussion.
Yep. I think 100% I would like to do that.
Great. Any other questions or comments on the governance calendar? Okay. So let me bring the screen back up again. And we will talk about capital markets. All righty. Oh, now my slides don't want. Okay, there we go. All right. So the third quarter was a difficult one in markets. We saw declines for the most part across most of the investable universe. But on a year-to-date basis, the markets have been in pretty good shape. We'll get to some asset class returns in a couple slides, but you know, broadly speaking, so we've been in 18 months of the Fed's rate hike campaign. They've hiked rates by 525 basis points. Broad consensus is that they are either at or near the end of their rate hike campaign. And when we look at how the market has reacted historically following a rate hike campaign, generally speaking, it's been good news on a forward-looking basis. So what we show you here in the top right-hand side of this page is in the last 5 rate hike cycles, how has the market performed on a 3-year forward-looking basis at the end of the rate hike campaign? And on average, the aggregate index, so broad fixed income, has produced a return of 7.8% on average. T-bills, so cash, has produced a return of 3.6% on average. And then the S&P 500 has produced a return of 12.3% on average. If you look at the S&P results, there's some mixed results there. You see 2 years where or 2 time periods following 2 rate hike campaigns where the 3-year results were negative, but those were the global financial crisis and the bursting of the tech bubble. So those were two kind of unique market environments. I think that most investors and most economists do not see any sort of a really significant dislocation or a bubble that's about to burst in today's equity markets. So it's our expectation on a go-forward basis that it probably should be a fairly strong market environment. That's not to say it's going to be straight up. That's not to say that we're going to have, over the next 3 years that it'll be all positive quarters. There certainly could be and likely will be some volatility. But if history is a guide, historically, when the Fed's rate hike campaign has come to an end, that has typically, benefited markets, or it's been a strong market environment. On the bottom left-hand side of this page, this is something that we've been talking about for many quarters, but we finally have an attractive bond market. So you can see for quite some time, S&P 500 yields were well above the yield of the aggregate index. I mean, look, that dispersion is, we hadn't seen dispersion like that. I don't think ever before, where bond yields were so unattractive. Now that interest rates have risen so substantially, you're actually getting not only an attractive nominal return from bonds, but an attractive real return from bonds. So on a forward-looking basis, our outlook for bonds is better than it was. And then in terms of the broad economy, things are chugging along pretty well. So there still is the question, will we enter a recession? Will it just be a cool down? What will happen? Again, as I've said for the last year or two, we wouldn't structure the portfolio. Even if we had a crystal ball and we knew that we were going to enter a recession, we wouldn't structure the portfolio any differently, because this is a broadly diversified portfolio. It's supposed to be kind of an all-weather portfolio, and it's very long-term in terms of its time horizon. So those comments aside, the economy is still chugging along pretty well. We just got a new GDP number today that was much better than what people were expecting. It showed GDP growth at 4.9%. So that's really, that would indicate a very positive U.S. economy. Now, that being said, the consumer is responsible for about 70% of GDP, and we're starting to see some weakness in the consumer. That's not to say that the consumer is falling apart, but folks had built up lots of savings during the pandemic. We saw, savings rates increase because people couldn't go out and spend money. And also we saw wages increase. And so people were earning more money, but had nowhere to spend it. So the average consumer built up a much higher amount in savings than they previously had. And then the economy's kind of been bumping along over the past couple of years as folks are spending those excess savings. Now we're starting to see that savings rates are going down. We're starting to see credit card debt increase, and we're starting to see an increase in delinquencies on credit card payments. And then we also have the added stress of the student loan repayments beginning. That's kind of weighing on the horizon. So that's not to say that, again, the consumer is still relatively strong as we look at their fiscal health in, across broad historical perspectives, but compared to how fiscally healthy the average consumer was 2 years ago, we're seeing more weakness now. And then the last comment that I'll make on the broad economy, a lot of headlines lately have been focused on the real estate market, and specifically the office portion of the real estate market. So here on the bottom right-hand pie chart, we just call out the makeup of the REIT market, so real estate investment trusts. And despite the fact that office space has been taking up all of the headlines, it represents a very, very small portion of the REIT market, only 5%. In your portfolio, you have the Principal Diversified Real Asset Fund. That's a 5% target allocation in the portfolio. And the principal fund does have exposure to REITs, but it doesn't have a lot of exposure to REITs. So let's say, the principal fund is 5% of your overall portfolio. A quarter of its portfolio is invested in REITs, and only a very small fraction of that quarter of the 5% has exposure to the office space. So that's just to give you a little bit of comfort that your portfolio, whatever happens within office space, if it's a near-term blip or if folks never return to the office 5 days a week, the jury's still out on that one. But rest assured that you don't have much exposure at all in your portfolios. So if we look at page 16, this gives you a sense for year-to-date performance across the asset class spectrum. So the bars represent the year-to-date performance and the bubbles represent the third quarter performance. So I mentioned that the third quarter was a really difficult one in the markets. You can see that nearly all of these bubbles, with the exception of high yield bonds and commodities, everything else was in the red, so had negative results for the quarter. And that was largely a result of the messaging from the Fed that rates were likely to stay higher for longer. So when we started out this year, the expectation was that the Fed would stop raising rates and that they'd probably begin to cut rates by the end of the year. Now that's largely off the table, and the expectation is that the Fed is going to keep rates high for the foreseeable future. So that messaging really weighed on the markets, and in particular weighed on small cap names. So you can see, small caps in general struggle more in a high interest rate environment. And then with this messaging of higher for longer, you saw a more significant pullback in small caps, down 5.1% for the quarter compared to down 3.1% for large caps. That being said, year-to-date results are still strong in absolute terms across the equity markets. You see very strong results from high yield within fixed income markets, but everything else for fixed income has struggled. And that's simply because we've been in a rising rate environment. Again, on a go forward basis, you're getting 5% from actually really across most of the yield curve within fixed income. So even if you strip away inflation, you're still looking at positive real results. And then mixed results from diversifying asset classes. But again, commodities kind of held up much better than other areas of the market when we saw that downturn in Q3. So
today's GDP report probably puts the kibosh on cutting any rates this year and keeping them high, and probably most likely we could still see another rate hike either late this year or next year, I would think.
Yeah, most folks think maybe one more rate hike, and probably most likely to be in the January meeting. But it's going to be 25 basis points. Most likely, I don't really see anything higher than that. And that is, according to consensus, which could be wrong, that's likely to be the last one. You're absolutely right that the very, very strong GDP report that we got today does mean that the Fed is likely to, stay true to their statement of higher for longer. And I think that's why the markets reacted poorly today. Like it's really weird to get such a great GDP report and then have the markets be down. But I think it's because of fear that the Fed will continue to keep rates high, or that, to your point, that they could hike again. That's a good point. All right. Any other questions? So you can see we don't need to get into all the details, but the longer term results of all of the indices are shown here on page 23. So that bar chart and bubble page just showed the year-to-date performance, but we can see the longer term results here. So let's get into the pension portfolios. So, for the quarter, so this represents the town plan, but again, the Board of Ed plan is structured exactly the same way with the same underlying investments. So for the quarter, the portfolio was down 3.6%. The blended benchmark was down 3.5%. On a calendar year-to-date basis, the portfolio is up 5.8%, just modestly ahead of the benchmark, which is up 5.1%. But that 1 year number is very strong, up 14%. So, you know, it's certainly been a volatile environment. Longer term results are right about in line with the benchmark, but not quite keeping pace with the actuarial return assumption of 6.75%. If we look on the following page at the asset allocation profile, you can see here the target allocation is represented in the lighter blue, and then the actual allocation is shown in navy blue. For the most part, we're right in line with targets. We always, we use the cash raises, which we do on a quarterly basis to fund pension distributions. We use those as a way to kind of organically rebalance back to the target allocation. So we will always be quite closely aligned. And on the bottom right-hand side of this table, you can see the minimum and maximum allowable allocation that is designated within the investment policy statement. So this is just kind of a gut check to confirm that we are in compliance with the investment policy statement. So here on page 27, we have the portfolio lineup. We don't have any recommendations for changes to the pension portfolios. We do have a recommended change to the OPEB portfolio. But I will mention that one of the strategies is on watch status. So the MetWest Total Return Bond Fund, I believe I did send a memo about this, has been moved away from maintain and put on watch status. So just to give a refresher, we assign a status for each of these underlying strategies on a quarterly basis. And they can be one of four statuses. One is maintain, that's a green light, no issues. Then we have two statuses that are kind of like a yellow light, discuss or watch. Watch is a more elevated level of concern than discuss. So discuss, an example could be, you know, a portfolio manager has announced a retirement, but is not the key decision maker, and the rest of the team has been intact for many years, and you know it's not likely to cause a disruption. In this case, MetWest has been placed on watch, which is that higher level of concern. And then just to round it out, the terminate is the final status, and that's when we would recommend a replacement. So MetWest is on watch, and the reason that they are on watch status is because there were three architects who originally came up with this strategy, and that kind of put all the pieces in place, built the team, really built the track record. One of those folks retired a couple years ago. It was expected, no surprises, very well planned out. Just recently, they announced that the other two portfolio managers will both be retiring within about the next year or so. So Laird Landman will be retiring at the end of this year, and then Stephen Kane, who will be the only remaining original architect of the fund, will be retiring no earlier than at the end of next year. So after the end of next year, none of the original architects will still be involved. And they've recently promoted several folks at the firm. These are people with long-term track records. They've been working on the fund for a long time. So it's nothing, we're not particularly concerned about the capability of the folks that they've promoted, but this does represent a really significant change. All three people who are responsible for the MetWest Total Return Bond Fund's track record will no longer be at the helm. So we're just keeping very close tabs on this. Our fixed income analyst is actually going out. MetWest is based in Los Angeles. He's going out for a site visit next week. So he'll do some really intense due diligence. We'll continue to keep an eye on that. But that's the only fund within the portfolio that we, you know, are keep it that is anything other than maintain. Any questions about that? Okay. So we've already discussed performance. Here on page 29, we capture all the statuses. I mentioned MetWest. And then here on pages 30 through I think 32, we get into some of the asset class results. So you can see that for fixed income, your managers have actually held up quite well relative to broad fixed income markets. So even though we're looking at negative absolute numbers, in relative terms, the results look strong. So for the quarter, your fixed income managers collectively were down 2.5%. But the benchmark was down 3.3%. And on a calendar year-to-date basis, your managers are almost even. So they're down just 10 basis points, whereas the benchmark is down 1.5%. And then on a one-year basis, your managers are positive, up 2.1% compared to 1.5% for the benchmark. So the BlackRock Strategic Income Opportunities Fund has been a bright light in the portfolio. So again, we've talked about this fund before, but it has a much shorter duration profile. It's much more flexible than the MetWest and the Baird fund. So it can go anywhere. It has a very flexible duration profile. So it has been shorter than the benchmark, which has been a benefit in this rising interest rate environment. And it just has exposure to a bunch of very diverse holdings within fixed income. So that BlackRock exposure has been very beneficial. You can see over the past year, that fund is actually up 3.4%. So that's been a bright spot in the portfolio. And then Dodge & Cox Global Bond, which we just added to the portfolio at the end of the first quarter, has also held up very well compared to the global benchmark. And on a year-to-date basis, that fund is also positive. So fixed income as a whole, when we look at this composite result here in the top third of page 30, results are strong compared to the benchmark. If we look at the domestic equity exposure, that's been a bit weaker. So we have the majority of the domestic equity exposure is indexed through the Vanguard 500 Index Fund. So of course, that just keeps pace with the S&P. Then we have active management on the mid-cap side, both value and growth. So Diamond Hill is our value manager. Conestoga is the growth manager. Diamond Hill has had some struggles. It's a pretty concentrated portfolio, so it's just single stock names that have detracted. So you can see on a year-to-date basis, that fund is actually down 1.1%, well behind the benchmark. So poor performance from them. Although they are not on watch or discuss status, that's something that we are keeping close tabs on. Their underperformance has been, given their stated philosophy and their approach, it's not particularly surprising, but of course, you do like to see downside protection. So that's something that we are keeping close tabs on. Conestoga, on the other hand, has been a really strong performer. So you can see we added this strategy to the portfolio in early 2021. And over the past year, that fund is up 16.8%, about 6 percentage points ahead of its benchmark. So very strong absolute and relative results. On the international equity side, we have all active management. So we have Dodge & Cox, and then on the next page, we have the John Hancock Dynamic Growth Fund that is sub-advised by a firm called Axiom. And then we have ARGA and GQG on the emerging market side. So complementary managers that are, both growth and value in both the developed and the emerging market space. Mixed results in the quarter. So you can see that collectively, those managers are right about in line with the benchmark. But on a year-to-date basis and on a one-year basis, the roster of managers collectively has produced returns ahead of the benchmark. So broadly speaking, value stocks held up better in the third quarter, but growth stocks have been better year to date. So you see some mixed results, and we're happy to have that, kind of style neutral approach, because then when something is in favor, we have exposure to that, and it just kind of creates a smoother ride. GQG is one of the standouts of the portfolio. That strategy was positive in the quarter, up 1.5%, whereas its benchmark was down 4.9%. So really significant outperformance. And then finally, the last piece of the portfolio is the principal fund that has exposure to commodities, natural resource equities, TIPS, infrastructure, and real estate. So it had kind of a tough quarter, but we like that diversified exposure to the real assets. That's kind of a hedge against inflation. So we think that 5% piece of the portfolio is an important piece. So no recommendations to make any changes within the pension portfolios. We're keeping an eye, obviously, on the MetWest transition, keeping an eye closely on the Diamond Hill performance, and continuing to evaluate that strategy. But at this point in time, no recommendations for change.
Yeah, and just a quick question on the international side. And I know long-term looks good. Is there any concern short-term with volatility that right now seems to be popping up all over the globe on the international investment funds?
No, we're concerned from a humanitarian perspective about the volatility that the geopolitical risk that exists throughout the globe. But from an investment perspective, no, we recognize that international markets tend to be more volatile, emerging markets even more so. And we think that the potential return profile is attractive enough to warrant the exposure. I'll also, if I can bring the screen up again, I think there's a helpful page. I'm going to scroll back a few pages and look at valuations. Valuations overseas, in our opinion, are much more attractive than they are in the US. So even though we saw a pullback really across the board in the third quarter, so valuations look more reasonable than perhaps they did 3 months ago, you can see this green bubble represents valuations at the end of the third quarter. So within the US, we are, within the realm of reasonability. So the blue line represents the median, and then this is the navy blue bar represents plus or minus 1 standard deviation. So we're within 1 standard deviation relative to the median, but we are certainly in the more expensive side. So US stocks look much more expensive. International developed, on the other hand, is 1 standard deviation cheap relative to history. So that means that they look like they're on sale big time, which would indicate that there's probably room to grow. And then emerging markets are right at about their median valuation. So again, from a valuation perspective and how cheap or expensive certain areas of the market look, international stocks look more appealing than domestic stocks. So that's something that factors in. Another thing that factors in is currency strength. We've been in a 12-year period where the dollar has been very strong. Currency leadership does not tend to continue forever. We'll probably continue to see dollar strength as long as there is this chaos. And we have the war in Ukraine, we have the war in Israel, that will likely result in continued dollar strength, but we don't think that dollar strength will continue forever. So again, once we see, if we do see the dollar pull back or simply not strengthen any further, that should be a benefit for international as well. So, if I were investing $1 tomorrow to just be in the markets for the next 6 months, would I put in international? Probably not, but we're investing for the very long term. So we're comfortable with the international exposure.
Thank you.
You're welcome. Any other questions?
No, I was going to ask basically the same question. So great job.
Perfect. Great
Just
minds.
coming in from Middle East last week, it's a very different world over there right now. They are much more concerned than we are.
Sure. Yeah. Well, that makes sense.
Yes.
All right, so let's go ahead and we can jump into the OPEB, and I can also make our portfolio recommendation.
Before you jump into OPEB, I'm going to jump off, but thanks so much for the presentation, and I'll talk to everybody soon.
All right, thanks, Jason.
Thanks.
Have a good night.
Have a good one, everybody.
Okay, Oh, I suppose this is I never even mentioned the asset values. That would probably be helpful. So this is the Board of Ed plan, ended the quarter at 13 point, just about 9 million. And the town plan ended the quarter at 13.6 million. So just to give you a sense of assets. All right, let's hop into the OPEB. As you know, the entire OPEB allocation is all in passive funds. We don't have any active management. So you can see that the performance has pretty closely aligned with the blended benchmark over most time periods. When you do see relative dispersion, like for instance, on a 1-year basis, the tendency is for a contribution to come into the OPEB plan, and then we dollar cost average into the market. So over the course of, let's say, the 1-year period, when at some times there was a bit of cash on the sidelines being, waiting to be put to work, that caused a little bit of a drag on a 1-year basis. So that's why you see the relative underperformance there. But for the most part, longer term tracking the benchmark as we would expect. The portfolio ended with a value just over almost 2.2 million. And you may have recalled that in the past, I said once we got to the $2 million mark, that's when we would consider adding active management. So here on page 56, you have the current allocation and underlying managers in the portfolio. Again, everything is completely passive. So we have only index exposure. And our recommendation, and these funds are tracking their respective benchmarks as you would expect. You can see their results on pages 59 and 60. But our recommendation is, now that we have surpassed that $2 million threshold, we'd like to add some active management within fixed income. So we think that's a good place to start. And so what we'd like to do, and I'm showing it here on page 66, is replace the Vanguard Total Bond Market Index with 2 active managers. One is Baird Aggregate Bond. So that's pretty traditional, going to fairly closely adhere to the aggregate index. Of course, they're very active in their bond selection and in their sector allocation and that sort of thing. But in terms of overall duration and that, and positioning, they should be fairly closely aligned with the aggregate index. And then we'd like to complement that with the BlackRock Strategic Income Opportunities Fund. That's the fund that I mentioned on the pension side has been such a benefit. It has a shorter duration profile than the aggregate index. So that's been helpful in this rising rate environment. So we think that the combination of these 2 managers on a forward-looking basis should be able to add some alpha to the portfolio. Any questions about that recommendation, or any concerns that you see?
Historically, how have the returns of the 2 you're recommending matched up with the Vanguard?
Well, we can actually look at that because both of them are in the pension plan. So let's take a look. I moved back to page 44. So Baird, for example, on a 1-year basis is up 1.4%. The aggregate index is up 0.6%. Just 20 basis points ahead on a 3-year annualized basis, 30 basis points ahead on a 5-year annualized basis. Modest outperformance, but pretty consistent outperformance on a long-term basis, and has ranked in the top quartile of the peer group over a 5, 7, and 10-year time frame. And then the Strategic Income Opportunities Fund, that's the fund that I highlighted earlier. Performance in recent history has been much stronger than that of the aggregate index, which largely is a result of their shorter duration profile. But longer term results are well ahead of the benchmark as well, up 2.5% annualized over the past 10 years, whereas the ag is up only 1.1%. So had we had these funds in the portfolio for the whole time, they would have outperformed. That's not a guarantee that they will continue to outperform in the future, but we do think that fixed income is one of those areas of the market where active managers do have pretty high potential to be able to add value above the benchmark.
Thank you. Thanks.
You're welcome.
Devin, this is Ron's. So the BlackRock, I get it's what, shorter term in duration than the Baird?
Yep.
Okay.
Well, and really, Ron, it's right now it's shorter duration. Over the past couple of years, it's been shorter duration. But the point of that fund is that it's very flexible. So it doesn't have to be most like Baird. I don't exactly know off the top of my head what their risk parameters are, but it's probably something along the lines of a duration plus or minus 20% of the benchmark. So they can't get too far afield from what the ag is doing. Whereas BlackRock has basically no guardrail. So they can have a duration between -3 years and 8 years. They can invest in emerging market debt. They can do some currency stuff. So it's just a much more flexible portfolio.
So I guess my question is BlackRock's outperformed and the recommendation is to go 10% BlackRock, only 10% BlackRock and 20% Baird.
Yeah.
The other way.
Yeah, that's a very valid question. BlackRock has been really meaningful and important in a rising rate environment because it has the ability to be so nimble. Now that we're more constructive on fixed income, broadly speaking, and we don't expect too many more rate hikes, and longer out on the curve, you are eventually going to end up with higher yields. We think BlackRock is basically more of a defensive play within fixed income, and we don't think that we need to be quite as defensive. So if we had made this recommendation a year or a year and a half ago, it probably would have been a 50-50 allocation or maybe even a little bit more to BlackRock. But on a go forward basis, we think the environment is such that Baird should be able to perform well.
Okay, thanks.
Any other questions about that? Did you want me to bring up that recommendation page again?
Sure. So I think it's on 66.
This is just OPEB.
And yes, this is just OPEB. We already have those managers in the pension.
So the only 3 people out for Mike Vitale is still on?
Yes, I am.
Okay. So the only 4 that would be voting would be Jonathan, myself, Mike, and Mike.
All right. Do you want to make a motion?
Yeah, so I'll make a motion to introduce active management into the OPEB portfolio and to approve the related fixed income changes to the portfolio as recommended.
Jonathan Kelly, second.
Okay. Any questions? Discussion? All right. Hearing none. Any opposed? And we pass unanimously.
Okay, great. So we'll go ahead and get the documentation in order to make that change. So that's it from my perspective.
Motion to adjourn.
I love the sounds of that.
6:40 to 90.
Thank you,
10 minutes. Perfect.
Thank you, everyone.
Awesome. Thank you, Devin. It's really a pleasure and look forward to seeing you in January.